Hello and welcome to Finest Skills Hub. Here we learn, we connect, and we grow. Have you ever wondered how banks create your loan repayment schedule? In this short video, we'll learn how to create a very simple loan repayment schedule using Microsoft Excel. So you can probably use it to track your own repayments. Let's get to it. So here we have assumptions for our loan. The loan is given at a rate of 32%. Principal loan amount is 25,000. This is running for 48 months, which converts to 4 years. The first thing we need to do is to calculate the equal monthly payment, the amount we pay at the end of every month, including interest and principal. We can do that using Excel's PMT function. So the PMT function requires a rate. Now, this rate is an annual rate, but we've been given the tenor in months. So to let the compounding agree, you need to divide the rate by 12. The number of periods is the end pair. So here I select 48 months, and my PV is the principal or the loan amount. So here I'll select the 25,000. In Excel, when you see arguments in square brackets, they are optional arguments. What we have here is FV for one-time future payments is optional. If you don't have it, you can leave it or put in 0. And type is payments at the end of the period or beginning of the period. In this case, we are making payments at the end of the month, so we choose 0 for end of period or month payment. So this is our equal monthly payment calculation. From this perspective, we are paying out money. So we need to negate the entire formula as a cash outflow. So this is 929.46. Next up, I'm going to put in the number of months in this loan repayment. It's 48. So I'll put the 1 here, hold down Control, and then drag down up to the 48th period. My opening balance is 25,000, so I will go and pick this 25,000. My equal monthly payments, I've already calculated it, so I'll reference it here. Use F4 to lock this so it doesn't move down as I copy. The interest portion is going to be calculated using Excel's IPMT. So equal to IPMT, basically the same requirements. So the rate is 32%, we divide by 12. The only difference now is that this rate I have to lock, okay, so that it doesn't go down with me. There's a new requirement here called PER, which is the period in question. So we are currently in period 1. I'll select period 1. The number of periods in this case is the entire duration of the loan, which is 48. So I'll press F4 so this doesn't go down with me. PV is 25,000, another F4, and FV is 0 and type is 0. So what I'm going to do is I'm going to copy this current formula because it's going to be the same as the principal part. I'll negate this and I have that. So when I come to the principal part, I'm going to paste this and then change the IPMT to PPMT, and I get that. My closing balance is my opening balance minus my principal. So I have this. Now we are done. The opening balance for period 2 is the closing balance for period 1. So all I'm going to do is just highlight this range and then copy down using Ctrl D. I'll highlight this entire range and now roll it down. So if I'm correct, at the end of the 48th installment, my loan should run down to 0. So this is how you calculate a simple loan repayment schedule. The key formulas here is the PMT, IPMT, and the PPMT. Please practice and add it to your list of Excel tricks.